Hey everybody, welcome to your week in review for the week of Monday, November 21st, 2022, and oh, what a week it was. At the beginning of the day, there wasn't much on the economic calendar to be moving the markets, and there weren't a lot of people back to work, so smaller things were moving it a little bit early on. A lot of the news was centered around COVID-related issues in China, a lot of turmoil and unrest, protests and things like that going on with the rise in COVID deaths and cases in China and the government's reaction to it. In pre-market trading, Apple Inc. dropped as reported the turmoil at its key manufacturing hub. Also, U.S.-listed Chinese companies like Alibaba and JD.com lost around. Once European markets fired up for the day, bonds began to lose some ground while stocks stumbled sideways on the U.S. Open. We were up about 3 basis points, which is essentially flat early on. The big week of data coming up with house prices on Tuesday, GDP on Wednesday, personal incomes and outlays on Thursday, and then the jobs report on Friday. The FHFA house price index will be released on Tuesday. This will be the final number before they establish the new conforming loan amounts for 2023, though the consensus seems to be right around 715,000 or so. PCE price index, the Fed's preferred inflation, will be released on Wednesday. We'll get one more CPI print before the Fed announces its decision in December. Single-family rents rose 10.2% year-over-year according to CoreLogic. Interestingly, the lag between home price appreciation and rents is about 21 months, which means that we are looking at home price appreciation from early 2021. In theory, we should see an acceleration in rental inflation as the home growth went up in 2021-2022. Big banks are largely focusing on the recession coming next year and a Fed funds rate of 5% plus. Most strategists think the S&P 500 will end 2023 lower than it is today. Fed policymakers stressed on Monday that they'll be raising borrowing costs to further curb inflation. Man, they were worse than Kardashians as much as they talked to the press recently. We've had John Williams, who said stronger demand for labor, stronger demand in the economy than previously thought, and somewhat higher underlying inflation suggests that they need to do some more hikes. In a separate speak, James Bullard, one of the Central Fed's most hawkish officials, said that he thinks the markets are underpricing a bit for the risk that the FOMC will have more aggressive rather than less aggressive stance. After all those comments at the end of the day, the MBS ended up being down 8 basis points, so we're trading in that range bordered by the 100-day moving average at 101.116 and a floor of that 100.534. It looks like we tested that today and then came back up. Also, with all the movements, the yield curve became even more inverted last week while volatility remained elevated. In terms of current coupon spreads, the 30-year MBS looked cheap while the 15-year looks rich. Due to the seasonals, which tend to favor mortgage performance during the winter months, December through February is historically the kindest period for mortgage excess return performance. December is the belle of ball in that regard. We also got data out of the MBA, which tells us adjustable rate apps are now below 9%, the lowest for the last few months. FHA total share of applications is about 13.5%. The VA is getting about 10.5%. USDA is getting like 1%. The percentage of first-time home buyers using FHA insurance is approximately 84% of the total forward mortgage market. The share of mortgage by FHA to borrowers with color reached 29% for all FHA forward mortgages, which is up from historical averages, which is good.